Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, as part of our Blossom portfolio review series, we have another update for you. We're going to go through the portfolio of several other blossomers that recently commented on my posts. Let's go through them. In the third episode series that I posted, we had a few folks commenting. Yara was one of them, as well as JC Bin. So Yara did mention that they would love the feedback on their portfolio and their rebalancing phase, planning to sell half of their HMAX and all of their CM, I believe that's the CIBC Bank, as well as VDY portfolio to diversify in other sectors since they are very financially heavy at the moment. Let's take a look at Yara's portfolio first, and then we're going to move on to JCPIN. Yara, if we just look you up here, let's take a look. Look at that, and I'm following you, Yara. You do not have the pro account, which is why on my list it's not going to show exactly sector by sector comparison, but nonetheless, we're going to take a look at all your holdings listed from your biggest exposure to the smallest one. You did mention that you're going to try to about half of your HMAX position to be kind of get rid of it. HMAX is the Hamilton Canadian Financial Yields Maximizer ETF. And it has quite a high yield, I believe, close to 15%. It seems like it. One of the things that I do think you're on the right path is that you've obviously, based on your comment, you've assessed your exposure to different market sectors and financials. You're feeling that you have a very heavy tilt towards and wanting to kind of rebalance it accordingly. I think that's a smart move for any investors. At the end of the day, it really depends on your own exposure tolerance. What you think is reasonable. I do think it's a smart idea to keep track of your exposure over time and try to rectify it accordingly. I do also notice that you have multiple banks as stocks in your portfolio. In fact, most of your holdings, I believe, are stocks. You do not have that many ETFs. It seems like your approach of investing is more so stock picking. I did notice you have shares of Royal Bank of Canada. You also have shares of TD. And then, of course, the CIBC, the CM that we talked about that you would like to get rid of. And here I can see that before diving into it a lot, I can see that you actually sold out of your shares of VDY today. And it seems that you had that at the profit. You indicated as nicely that Royal Bank of Canada, TD, and Enbridge are some of the top holdings for VDY, and you hold them individually. So it made sense for you to free up some of the cash to buy other stocks. I think that's a smart decision, and you're going to save on that, especially given that your style of investing seems to be more geared toward stock picking. In terms of the other holdings, I do notice you have shares of 𝗋𝐋𝐈𝐖, which is an all-in-one ETF. Many investors here we see on Blossom ask about that. They talk about what's the difference between 𝗋𝐋𝐈𝐼 versus 𝗋𝐋𝐈𝐼, and is there any value in it? I'm sure you're very familiar with it as well. Through 𝗋𝐋𝐈𝐼, you do get exposure to the US market for about that 47% or 46% exposure. It also gives you exposure to some Canadian market as well, about 24%, international markets to that same 24 to 25%, and the remaining around 5% or so belongs to exposure to the emerging markets. Initially, one of my comments on your portfolio was that I don't see a ton of exposure to the US markets. When I added them up, all in all of your US exposure stocks, you were hovering around that 13 to maybe 11 to 13%. But you are getting some additional exposure to 𝗋𝐋𝐈𝐼. Just keep that in mind. The reason I say that is that US is one of the largest economies in the world. So it would make sense for you to try to maintain a higher exposure to the US stock market. For me personally, I've selected to get such exposure by investing in shares such as the shares of VFV. I've also recently added to my position shares of QC as well as XUU. But there are a ton of other ETFs or even high quality stocks out there. I do see you have some of them in your portfolio. It's just that the percentages that you're investing in then is not to the point that you have enough of that exposure to the US market. Something for you to keep that in mind. The one other thing that stood out for me personally is the fact that you do have some of these funds that are for example, if you look at ENCC, Horizons Canadian Oil and Gas Equity Covered Call ETF. It's a personal choice For me personally, I'm not the biggest fan of covered call ETFs. I understand that they could be a good strategy for investors who want to get additional income through holding on to these ETFs, but the downside to them is their returns. Now for ENCC, it seems that when you look at the past returns, like over all the time, you're not gaining as much. The past 5 years return was negative 4.6, 1 year return was down 8.3, and so on and so forth. Even though you're collecting a very high dividend, over time, you're losing value in terms of the appreciation of the fund. Unless depending on your risk tolerance and depending on the use case for those dividend distributions, you might think that you are able to repurpose them and reuse them to buy other quality shares. That's something to consider. It's never been something for me as attractive of a option as an investor. The other one that I want to bring to your attention here is HUTS, Hamilton Enhanced Utilities. Even though it does pay a decent yield of around 5%, 4.8%, when you look at their past returns, again, past months, almost stagnant, but past 1 year is down by close to 18%. If you look at past 5 years, I don't think it's been around that long, but ever since its at least inception, it's down by 10%. Sometimes some of these funds that are very much focused on a specific sector, there is going to be some of that risk associated with that, because you're pretty much putting your eggs into one basket of that sector. You're anticipating that sector is going to do well. I'm curious, what were some of your thought process behind it, selecting to invest in the utilities sector to this fund? Was it the main reason having that dividend income coming your way, or was there other reasons? Do let me know in the comment section. I would love to hear from you. All in all, I think your portfolio does look intriguing. If I look at the all-time return for it, it seems to be up by close to that 5%. That's decent. You may want to also consider the varying number of shares that you have. For me personally, it does sometimes get a little bit too much, having to consider all these different holdings. A few recommendations that I have for you, Yara, it might be maybe consider increasing your exposure to the US stock market, however you see fit. And the other one is perhaps being mindful of some of these funds that are mainly focused on covered calls or very much sector related exposure. Some of those ones require some additional attention. And there's this one as well. I just noticed you have around 1% of your holdings in Horizon's US dollars currency ETF. I'm curious, what made you pick this ETF? It seems that it's mainly geared towards getting some exposure to potential gains in the US dollar currency, I would suspect, but I'm not as familiar. I'm genuinely interested in it. And do let me know, given that you don't have a huge exposure to it, I'm just curious what made you add that as well to your existing holdings. Moving on, we're going to take a look at the other folks that had a comment for our portfolio, and that was JC Ben. They did mention that they're fairly new to investing. And before I proceed, I'm just going to follow JC and then we get into their portfolio. Let's take a look here what holdings they have. And with JC, they are currently a pro member, so it would be easier for us to compare. Right off the bat, one thing I noticed, JC and others, you do see in terms of the sector exposure, JC's exposure is 41% to financials. That's a massive exposure to the financial sectors. Even for me, I think I'm very much heavily tilted towards financial, and my exposure is 26%. So JC, just something for you to be mindful about. That's a huge exposure to one sector alone. Your next big exposure is to energy sector at 32%. That's still a massive exposure. If you think about it, these two sectors alone, financials, energy, account for close to 73% of your exposures. That's just massive. And the rest of the sectors are a lot smaller in size. If you go back and take a look at your holdings as a whole, let's see, your biggest holding is Enbridge, close to 16%, Bank of Nova Scotia around 15%, and VFV at 13%. These are your top three holdings. You do have a few of the Canadian banks separately as stocks, such as Bank of Nova Scotia and TD. If I move down, you do also have shares of Royal Bank of Canada. Then I noticed that you have shares of VDY. It's a great holding for monthly dividend income for Canadian investors interested in Canadian dividend-paying stocks. With VDY, you get exposure to close to that 55 or so Canadian companies, but you also have shares of 𝐋𝐈, and it definitely is a redundancy. With 𝐋𝐈, it's very much similar purpose. You're trying to collect dividend income from high quality dividend-paying Canadian companies, but with 𝐋𝐈, your exposure is a little bit more to around, I would say, 70 companies or so. VDY is tilted heavily towards financial sector. I believe close to 55% or so exposure of VDY holdings are towards financials, and the next big exposure is to energy. Whereas with 𝐋𝐈, it's a little bit more balanced. I believe your exposure to 𝐋𝐈 to financial sector is around 31%, and after that you have around 30% exposure to energy. Between VDY and 𝐋𝐈, I do encourage you to perhaps pick one that you think works best for your portfolio. If you want to lower your exposure to those two sectors that you're heavily exposed to, energy and financials, I do think 𝐋𝐈 might be a better pick because of that. Because at least by getting rid of VDY, you're trying to offload some of your heavy exposure to those two sectors, financials and energy. Another thing to keep in mind is because you would keep either 𝐋𝐈 or VDY, as part of their underlying holdings, they have shares of Royal Bank in them, they have shares of CNQ in them, they have shares of TD in them, they have shares of Bank of Nova Scotia in them, Enbridge in them. It would be worthwhile for you to reconsider whether you want to still maintain these specific companies' shares separately, or make things simpler and just hold on to like that ETF instead, which takes into rebalancing of their positions for you automatically. Those were some of my observations for you. The last one probably would be very similar to what I mentioned for Yara, JC. Your exposure to US market doesn't seem as much to me. If you look at it, you have around 13% exposure to VFE. The rest of it, it seems like mostly everything else here is focused on Canadian market. Given that US is one of the largest markets in the world in terms of economies in the world, personally, I have that exposure of around 50 to 60% target. I'm not there quite yet. I think my exposure to US markets is around 45%, but that's where I'm heading personally. I'm not saying that's exactly what you need to be doing. Of course, this is not a financial advice. This is just my 2 cents, but something for you to keep in mind. It seems that you have a lot of exposure to Canadian stocks, and Canadian markets and Canadian economy is not such a huge part of the world economy. Sure, it's an important contributor to the world economy, but in terms of the percentages of the weightage in the world economy, probably is hovering less than 10%. That's something for you to be mindful about. And lastly, there's one last portfolio that we would like to review quickly. It's from BAG. They did mention something earlier today, and they wanted the portfolio to be reviewed. And I saw that there was another fellow Blossom friend as well who commented and mentioned that their portfolio is way too many holdings. And I certainly agree with them. It's way too many stocks and holdings. I believe closer to 50, too much. And I think you're aware of it. That's something for you to continue to work on. How can you try to consolidate your portfolio, choose the number of holdings that is more manageable for you, something that you can spend time on and focus on and get excited about, as opposed to something that is just, unfortunately, maybe a point of a stressor. Your biggest holding currently at only about 9% is V Equity. I think it's a great holding. With V Equity, you get that diversified investments throughout the entire stock market, to US, Canada, emerging and international. I think it would be probably a wise idea to expand your exposure to V Equity. A few things that stood out for me are, let me just quickly bring for you. You do have shares of VDY, and at the same time, you also have some other companies on the side separately, like Bell or Enbridge, or like things like TELUS, and these are all underlying holdings of VDY. You don't need to hold these companies separately unless there's a specific reason and you're thinking that you want to expand your exposure to these companies separately. It seems like I'm sounding like a broken record, but some of the observation on your portfolio, which I wanted to bring to your attention. Let me see if there's anything else that stands out for me, to be honest with you, because you have so many holdings, and many of them I'm either not as familiar with, or companies that I've never even sometimes heard of. be mindful of that. If I sort your overall holdings by their returns, you do see definitely some positive returns, but you also see a lot of negative returns. And your worst performing ones, even though they're so small, I can see probably they are very, very small positions. If this was my portfolio, I would try to probably gradually get rid of some of those small holdings that are I'm not as familiar with. Maybe the companies that I got into at one point in time, maybe I heard something about them or I really got excited about them. But right now, as I do my research, maybe these are not the companies that I can relate to. Those are not the companies that I can actually understand their business as well. I think those would be good options for you to gradually get rid of. For new investors or even investors who've been investing for a while, I think it's always wise for us to be investing in businesses that we recognize or business that we can relate to, we understand their concepts, especially if you're going for stock picking. I think when it comes to picking index funds, that would be a different story. I don't think with index funds, you have to necessarily understand every single underlying business, because with index funds, sometimes you're getting exposure to the entire index, like S&P 500 or Dow Jones or NASDAQ. And there are so many companies as part of it. And that's the beauty of index funds, because with index funds, you're your best performers are kind of averaging out the return of the worst performers. And after all things taken into account, you're still getting that average return, which is in many cases quite decent, especially if you're investing in an index fund and that is broad market, like S&P 500 or the entire Toronto Stock Exchange, or let's say the international markets indices, or one for emerging markets. They're going to be typically decent returns. Not all the years, especially for some of the markets that are higher risk, like international markets or, as an example, emerging markets. But all in all, they're more manageable as opposed to like companies that suddenly can go bankrupt. And it's going to really wipe out all of your investments if you put all your investments in that one single company. Well, I hope you all found this video beneficial. And Vag, I'm going to give you a follow as well. If you did, don't forget to smash that like button and subscribe to Momentum channel. I try to post these video series more frequently because there have been so many folks who have shown interest and wanted their portfolio to be reviewed. I'm not a financial advisor. I'm just a passionate investor myself. I have invested quite a bit of money in the stock market. My wife and I have close to $500,000 now invested in the market. I have my YouTube channel. That's where I talk about this topic because that's something I'm passionate about. But these are all for entertainment purposes and based on my own personal experience. It's not a financial advice whatsoever. I would love it as well if you follow me on Blossom Social. That's where you can see the latest and greatest of my holdings, what I'm trading. As an example, you do see today I sold some of my shares of VDY that I had in my portfolio. I sold, in fact, the entire holdings in my RSP account. I still have, as you see in the post, I still have more than 2,200 shares of VDY, quite an extensive amount, but I'm trying to put my money where my mouth is. I talked about, managing your exposure to different market sectors and different geographical sectors. And I have actually heavy exposure to Canadian markets. I'm trying to manage that. And that's why I try to get rid of the shares of VDY in my RSP account. I'm repurposing and reusing those funds to buy shares of VFE, as you see I did today. Buy more shares of XEC to get my exposure to emerging markets increasing. Buy more shares of XEF to increase my exposure to international markets. I'm also trying to get into this new position, which you see, QQC, which is for NASDAQ 100. I'm trying to build some exposure, higher exposure to that, and increase my exposure to the US markets. With that, I hope you found this video beneficial. Leave me a comment down below and let me know what you thought. Thank you, and I hope to see you all next time.